This is one of our favorite parts of the evening. And again, we do wish it was live, but we do appreciate all the questions that were sent in by our clients prior to the taping of this event. We're going to start off with a question for Dan I. And the question is, how will the Biden administration affect the stock market for the next 4 years?
Yeah, well, first I would say that probably pretty difficult to make any hard and fast predictions for the next 4 years. It won't be long or too long until we're talking about midterm elections, and historically the incumbent party has lost something like 5% of their seats in the midterm. So we'll see how things look this year, but the composition of Congress certainly could look a lot different in a couple of years. But for now, we think a good baseline assumption is for higher government spending than we would have expected under a more divided government, larger additional COVID relief packages, and a focus on infrastructure, all of which we'd expect to have a positive impact on top line economic growth. I think we should also expect some incremental changes or marginal changes or increases to personal tax rates for the high income earners and corporations, but nowhere close to the type of tax policy changes that would be required to actually pay for the increased government spending. So far we've seen the market react very positively to expectations for higher growth rates, and even more of a positive reaction for more economically sensitive sectors of the market. But going forward, I think the question will really be, is there a price to pay for that near-term bump in economic growth? And that price could come in the form of some of the things that Jay and Charlie have already talked about. There's the potential for higher interest rates and higher inflation levels. So those are some of the areas where we will remain focused.
Here's a question we're going to also provide to Dan. What is the projected growth for 2021, 2022, and 2023?
Sure. So I assume the question is referring to GDP or economic growth. And if we look at the estimates from the Federal Reserve for the U.S. Growth rate estimate is for 4.2% this year, 3.2% for next year, and then slowing down to 2.4% for 2023. After that, the assumptions are that we move back towards kind of a long-term trend growth rate around the 2% mark. Global growth estimates are a bit higher for the next several years, really driven by the higher growth in emerging market economies. And all those estimates seem fairly reasonable, rational to assume higher than average growth as we dig out of the from the economic impacts of the pandemic, and then we return to something that looks like trend growth in the 2% range.
Thanks, Dan. Very insightful. Here's a question for Charlie. Are you concerned with the level of the national debt and that could cause a dramatic drop in the stock market? And what could we do about it?
As I mentioned during my prepared remarks, the bill for the COVID response is going to have to be paid by someone. I mentioned that the U.S. national debt per working individual at the end of next year could be approaching $100,000. So thus far, the financial authorities, the Federal Reserve, the central bank in the U.S., has decided to fund these debts with newly printed money. But at some point, the amount of money that's required to fund these debts could become significantly inflationary. So yes, I am concerned that the debt levels within the U.S. economy, particularly public debt, could approach a level where we would have to really aggressively inflate the economy. And at that point, we would start to see the popular measures of inflation begin to rise materially, and it may be difficult for the central banks to be able to get control of inflation measures that begin to rise. Perhaps a doubling in the inflation rate within a year or two would be a real problem for the central banks. So, the debt is going to be an issue, but we've been able to kick the can down the road so far. As far as how individual clients might respond to the debt problem that I was mentioning earlier, the debt issue really becomes a problem for the markets if inflation becomes the policy to respond to it. So, a significant rise in inflation would be the sort of the outcome from the debt problem. So the way we've chosen to respond in our portfolios is to skew the portfolios a little bit more towards cyclical businesses, businesses that respond better with stronger economic growth, because the ahead of any inflation, we would see stronger economic growth. So cyclical businesses, companies like industrial businesses, materials companies, companies that are responsive to a stronger economy should do better as a precursor to any inflation. And that's exactly the way we positioned our individual securities portfolios at Fort Pitt Capital.
What do you know about investing in SPACs? SPACs. SPACs. Tell us about that.
SPACs, a market phenomenon in 2020. A SPAC is a special purpose acquisition corporation. It's basically what used to be known as a blank check company. A blank check company is a business that its sole purpose is to take itself public before it has any operating characteristics or even has a real business. So what happens is sponsors of SPACs, typically hedge fund managers, prominent investors, come to the market and say, we are going to raise money, typically with a 2-year window that says if we haven't invested the money that we've raised within 2 years, the money will go back to the investors. But the point is, it's a very, and basically a purely speculative investment on the track record of the people sponsoring the SPAC. There's no operating business. There's nothing real there yet. It's basically you're trusting that the people you're giving your money to who are running the SPAC are going to invest it successfully without any track record. And it is purely a function of a very speculative marketplace. Again, SPAC stands for Special Purpose Acquisition Company. And my acronym for SPAC is Separate People from All Their Cash. So from an investor's viewpoint, purely from a fundamental viewpoint, I would stay away from them.
Thanks, Charlie. Carter Henderson, you're a young guy, so you get the cryptocurrency question. There seems to be a shift in attitude about cryptocurrencies. What is your prediction about cryptos?
Well, I don't think it's a coincidence that the rise in cryptocurrencies in 2020 goes hand in hand with the rise in government debt or the money printing that we've seen from the Fed. I think there's fears about inflation and a weaker dollar, and I think those are justified. A lot of people think that Bitcoin is a hedge or other cryptocurrencies are a hedge to inflation or a weaker dollar. We've seen a lot of use cases being adopted over the last couple of years. A lot of hedge funds, insurance companies, and companies overall are taking interest. So, I mean, it's not without being said that it's still a speculative investment, speculative asset. But, you know, the use cases we see going forward, the blockchain, decentralized finance networks that are the technology behind these cryptocurrencies are definitely something to watch.
I see the Lowe's store near me is closing. Should I be concerned about this because it's part of my portfolio?
No, I don't think you should be worried. This is just a strategic move by a company like Lowe's to close underperforming stores and open stores in more strategic locations. They're opening up billion-dollar investment properties across the United States, distribution centers to grow their e-commerce business, which we think will be a significant tailwind for them going forward.
Wonderful, Carter. Really good job on that answer. Here's an interesting question for Dan I. Amazon, Facebook, and Google have been described by some as virtual monopolies. Given the dominance that these companies have in the marketplace, why haven't they made the cut in the portfolios?
So that's certainly a valid question. First I would say if you were to look at the 5 largest technology stocks or the FANG stocks that get a lot of attention because of their industry dominance and frankly their strong performance track records, we aren't void of any exposure there. Certain strategies have exposure to technology companies like Microsoft. Others have exposure to Apple. So I think that's a pretty important point. We also have very significant allocations to the broader technology sector as well. So we want to continue to stay diversified and not be overly exposed to any one sector from a risk management standpoint. And as many of you know and have heard from us before, valuation is a key component in our process. We think the biggest risk for equity investors is paying too much for a business. And as a result, not all companies or tech companies, pass our valuation criteria or metrics. We think that, valuations are too optimistic or assume, too rosy of an outcome in a number of areas, and don't account for things like increased competition, increased regulation, or changing technology trends. So on the three companies that you mentioned, obviously great businesses and no arguments that those, are dominant franchises. Not crazy about the valuations there. And we do, think it's a mistake for investors to assume that any business is bulletproof or without risk. And that's why we want to stay diversified and position portfolios for multiple outcomes.
What concerns do you have about the short-term prospects for the market and the long-term outlook for the market?
So short term, I would say, some of the things I've talked about already, valuations and bullish sentiment. As I talked about, stocks aren't cheap especially at the index level. We certainly think that, our holdings are attractive and there are plenty of cheap stocks in our portfolios. So we aren't necessarily constrained by high index level valuations. But I do think, investors need to be cognizant. They need to realize that, their going forward return expectations should probably be lower today, with the S&P at 3,800 versus, back in March of 2020. When the S&P was at 2,200. So that's kind of the short-term concerns. I'd say longer term, it's probably debt and deficits, which I think one of Charlie's slides really put into good context. At the beginning of this century, 20 years ago, we had something like $20,000 worth of federal debt for every working age person, and today that's ballooned up to $80,000 per person. And obviously, that trend is just not sustainable. And, it would be much more difficult to service that debt if interest rates were at 3 or 4% versus 1%. So longer term, investors could, demand higher rates to buy U.S. government debt, which would have, an impact we'd expect to have an impact on equity markets. There could also be implications for the reserve status of our currency, and do we see debt service cost really take a bigger bite out of budgets?
2020 was obviously a tough year for the institutional investing landscape. Fort Pitt Capital Group works with a lot of nonprofit organizations and institutional investors, and we provide a service called Outsourced Chief Investment Officer. Carter Henderson from our firm is going to describe how that service helped these investors through a very tumultuous year.
Yeah, so Outsourced Chief Investment Officer is a service that we offer to institutional investors, nonprofits, foundations, endowments, pension plans, and it really allows Fort Pitt to come in and be a strategic partner for these organizations. These organizations may not have all the resources or the time, the effort to put towards investment resources, investment planning, and investments overall. So, we come in as a strategic partner, alleviate the pressures of a fast-changing market, and allow these institutions to really focus on their mission overall.
Here's a question for Charlie Smith. Are we in an economic bubble? Should those of us in our 80s hedge our bets? And if so, how?
I do not personally believe that we're in an economic bubble. In fact, if I was going to be characterizing the next year in terms of the economy versus the markets, I would believe that the economy is actually going to be pretty healthy, while the markets might not do as well as they did in calendar 2020. I think economic bubbles are generally characterized by much stronger inflation than we're seeing right now. Actually, we've seen inflation for a decade or more at record low levels. So an economic bubble is not what we're suffering right now. I think the markets could be characterized as closer to a bubble condition, in particular with regard to the prevalence of the SPACs that I was just discussing a moment ago, and the level of speculative activity in both the stock and the bond markets.
Appreciate that, Charlie.